Welcome to another episode of Delta Investments Deep Dive, where we go in depth and unpack our research on specific stocks and discuss the risks. We are recording this episode on Monday, February 17th, 2026. And look, the stock market is entering a really critical stretch this week. It's a holiday-shortened start, and you can feel investors shifting their focus. It's all about Federal Reserve policy and some pretty high-stakes economic data that's coming down the pike. After 2 consecutive weeks of losses for the S&P 500, and a lot of that was driven by, that volatility in the tech sector, market participants are just looking for some sign of stability. The main concern really is whether the current economic growth can keep going without reigniting inflation, especially with these high interest rates still pressuring corporate margins. So the highlight midweek is going to be the release of the FOMC meeting minutes on Wednesday. Those notes are going to be scrutinized for any hawkish or dovish signals about when or if we're going to see interest rate cuts later this year. The Fed has been, cautious to say the least. But any hint that policymakers are getting more comfortable with the inflation trajectory could spark a relief rally in equities. On the flip side, if the minutes show a consensus for keeping rates higher for longer, you could see those growth-oriented sectors, like tech, facing even more selling pressure. Then the week wraps up with a big data dump on Friday. We're getting Q4 GDP and the core PCE price index, which is, the Fed's preferred inflation metric. These reports are basically the definitive health check for the U.S. economy. A strong GDP number combined with cooling inflation would really support that soft landing narrative everyone's hoping for. And outside of all that macro data, we've got earnings reports from major players like Walmart and Palo Alto Networks. They'll give us a real pulse check on consumer spending and cybersecurity demand, but honestly, we need to pivot away from all that macro anxiety because there is a very specific storm brewing in the market that we just can't ignore. It's a storm centered around one company that has been generating headlines at a just frantic pace since the ball dropped on 2026.
Oh, it really has. It feels like they've been the main character of the semiconductor world for the last 6 weeks.
Yeah.
And, not always for the reasons they'd want.
Exactly. We are doing a deep dive into Intel Corporation, ticker INTC. And before you roll your eyes and think, old tech or dead money, you have to look at where we are standing right now. It is February 2026. The whole narrative around this company has shifted so violently, it's giving investors whiplash.
It is a fascinating moment in time. It really is. If you look at the technical landscape, Intel is arguably at a crossroads we haven't seen in maybe 20 years.
Mm-hmm.
On one hand, they have technically reclaimed the lead. They are doing things in manufacturing, specifically with this 18A node that nobody else, not even TSMC, is doing yet.
Not yet.
But financially, the market's absolutely punished them.
Punished is putting it lightly. We saw that massive volatility in late January. The stock took a 17% nosedive in a single day.
It was brutal.
And that's the conflict we are here to unpack today. It's sort of the mission of this deep dive. We have this incredible duality. Intel has achieved its technical moonshot. The 18A process node is live. It works.
Right.
But the stock charts look like a disaster scene. So the question is this a classic value trap where you're just catching a falling knife, or is this the buying opportunity of the decade?
That really is the billion-dollar question. And to answer it, we have to synthesize a lot of different moving parts. We've combed through the recent 10K filings, the Q4 2025 earnings, which were, they were eventful, to say the least.
Eventful is a good word for it.
We have the press releases about some massive investments from NVIDIA and SoftBank, and we have a lot of technical analysis on what some people are calling the Silicon Renaissance.
Let's start right there with that renaissance, because for years, the knock on Intel was simply that they couldn't execute.
Right.
They were stuck on old technology while TSMC in Taiwan and Samsung just zoomed right past them. The former CEO, Pat Gelsinger, made this promise years ago. 5 nodes in 4 years.
I remember that.
And at the time, it sounded impossible. It sounded like a desperate PR stunt.
It sounded like marketing fluff, frankly. I mean, in the semiconductor world, a new process node usually takes 2 years, if you're lucky, sometimes more. Doing 5 of those transitions in just 4 years is, it's historically unprecedented. But here we are, early 2026, and you have to give credit where it's due. They did it.
They actually crossed the finish line on that.
They did. As of January 2026, Intel has officially entered high-volume manufacturing, or HVM, for the 18A process node. Now, for those not deep in the weeds of nanometers, 18A is the 1.8 nanometer class node. This is a huge deal because it represents the completion of that insane roadmap.
Okay.
But more importantly, it is the first time in a decade, maybe longer, that Intel can arguably claim feature leadership over TSMC.
Feature leadership. That's a heavy phrase. I want to stop you there because 18A just sounds like another number. What is actually under the hood? Why is this specific chip technology such a game changer? And I don't want the marketing brochure version. I want the physics.
Okay, let's get into the physics. It really comes down to two major innovations that they managed to commercialize before anyone else. The first is something called RibbonFET, and this is the biggest change in transistor architecture since 2011.
RibbonFET. Okay, explain that. How is it different from what we had before?
Well, to understand RibbonFET, you have to understand why the old technology, FinFET, kind of ran out of steam.
Okay.
Imagine a transistor like a little bridge. Electrons flow across the bridge, and there's a gate. Think of it like a toll booth that wraps around three sides of that bridge to stop the flow when it's supposed to be off. That worked great for a long time. But as we got smaller and smaller, down to like 3 nanometers, the bridge got too narrow, and the gate just couldn't pinch it tight enough anymore.
So the electrons were leaking through. Is that what was happening?
Exactly. It's a quantum mechanics problem called quantum tunneling.
Okay.
Even when the transistor was supposed to be off, electrons were just slipping past the gate. That leakage creates heat, and it absolutely kills battery life. FinFET physically just ran out of gas.
So what does RibbonFET do differently? How does it solve that leakage?
RibbonFET changes the geometry completely. So instead of a bridge, think of a stack of nanosheets, almost like a tiny stack of paper suspended in the air. The gate doesn't just wrap around 3 sides anymore. It wraps around all 4 sides. It completely surrounds the channel, 360 degrees.
So it's total containment. There's nowhere for the electrons to leak.
Total containment is what's called a gate-all-around architecture. And because you're squeezing that channel from every single direction, you have absolute control over the current. You can shut it off completely with basically zero leakage, and you can turn it on with less voltage.
So less leakage means better battery life, and that better control means higher performance.
Precisely. It also supports 8 distinct logic threshold voltages. Now, what that means is that engineers can fine-tune the chip for very specific workloads. This is especially important for AI, which is incredibly power-hungry. If you need a core to be super low power, you can tune the ribbons one way. If you need maximum performance, you tune them another way. It's incredibly flexible.
Okay, so that's the transistor itself. But the second innovation you mentioned, PowerVia, that sounds even more radical. I've heard it described as backside power delivery. Why is that such a big deal?
This is where Intel really took a risk, and it seems to have paid off. Traditionally, a silicon chip is built like a skyscraper.
Yeah.
You have the transistors, the people on the ground floor, then you build layers and layers of wiring above them. You have signal wires carrying data, then you have power wires carrying electricity.
And they're all fighting for space in the same elevator shafts, so to speak.
Exactly. It becomes a rat's nest. As chips got denser, the power wires were creating interference-like electronic noise that was corrupting the data signals right next to them. Plus, just pushing power down through 15 or more layers of metal wiring creates resistance. You lose power as heat before it even gets to the transistor. This problem is called IR drop.
So you're wasting energy just trying to get the energy to the engine.
Right. PowerVia solves this by basically cheating physics. They build the transistors, and then they flip the entire wafer over. They grind the silicon down until it's almost impossibly thin, and they attach the power wires to the back of the chip.
So they completely separated the power from the data. Power comes up from the bottom, data sits on top, and they never cross paths.
Precisely. It solves the interference problem because the power lines never touch the signal lines. And by doing this, Intel delivered a 30% increase in transistor density, because you don't need all those big power wires on top anymore, and roughly an 8 to 10% gain in performance per watt right out of the gate.
Wait a second. If this is so good, why isn't everyone doing it?
Because it is terrifyingly difficult to manufacture. You're taking a silicon wafer, which is incredibly brittle, flipping it over and grinding it down to just microns without breaking it or misaligning the billions of transistors you just spent weeks building.
Wow.
TSMC is working on this, but they aren't expected to have it in their N2P node for at least another 18 months.
That is the key stat right there. Intel has an 18-month head start on backside power. In the tech world, that is an eternity.
It is. It's the first time in a decade, maybe more, that Intel is actually ahead on the calendar.
So they have the best transistor, they rewired the plumbing. Does this actually translate to products we can buy, or is this all just a cool lab experiment?
Oh, and it's real. The first consumer product built on 18A is the Panther Lake laptop CPU, which is the new Core Ultra Series 3. It launched recently. And the specs are startling. They're claiming a 27-hour battery life.
27 hours on a laptop. That's pushing into multi-day territory for a lot of users. That fundamentally changes how you use a laptop. You don't even think about the charger.
It does. And it has an NPU, a neural processing unit, that's capable of 50 TOPS. That's trillions of operations per second. And this is significant because it proves Intel can finally compete in mobile efficiency. For years, Apple's Silicon, the M-series chips, just embarrassed Intel on battery life.
Oh, totally.
You'd unplug an Intel laptop, and the battery would die in 4 hours. Panther Lake is the answer to that. It proves the manufacturing technology really works in a high-volume product.
Okay, so the tech is solid, the silicon renaissance is real. But Intel isn't just making chips for Dell and HP anymore. The biggest part of this turnaround story was that pivot to becoming a foundry.
This is the IDM 2.0 strategy. IDM stands for Integrated Device Manufacturer. And you're right, Intel is no longer just building Intel chips. They're renting out their factories. They are a systems foundry. And they've even split their financial reporting, so now we can actually see the numbers for Intel products versus Intel Foundry.
And to make a foundry work, you need customers. And not just any customers. You need whales.
You need the big ones.
And looking at the reports from late 2025 and early 2026, it seems like they caught some really big ones. But I have to play devil's advocate here.
Go for it.
Why would Microsoft and Amazon switch? They have basically infinite money. They use TSMC for everything. TSMC works. Why would they risk their entire product roadmap on Intel, who, let's be honest, has a shaky execution history?
That is absolutely the right crumb to ask. And the answer isn't just about performance, it's about fear. The buzzword in the industry is sovereign silicon.
Sovereign silicon.
Yeah, look at the geopolitical map. TSMC is in Taiwan. If China were to blockade Taiwan, or if there was even just a significant earthquake there, the entire global economy literally stops. Microsoft and Amazon and Google cannot have 100% of their critical supply chain located on one single vulnerable island. It's just too risky.
So it's basically a very expensive insurance policy.
It's a hedge, a multi-billion-dollar hedge. Microsoft is using the 18A node for their custom Mia AI accelerators. That's the chip they designed for Azure. And Amazon Web Services signed a massive multi-billion-dollar deal for their custom AI fabric silicon and graviton chips. They're paying Intel to build these chips in Ohio and Arizona because they need a supply chain that doesn't cross the Pacific Ocean.
It's the Made in America premium. But there was one customer announcement that I think shocked everyone. I remember seeing the headline and I had to do a double take. Apple.
The Apple bombshell. Yes. Intel has officially qualified 18A for a portion of Apple's M-series silicon, specifically for the chips going into their entry-level MacBooks and iPads.
This is just wild to me. This feels like getting back together with a toxic ex. I mean, Apple famously fired Intel.
They did.
They dumped them in a very public way, made their own chips, and then just humiliated Intel in all their marketing for years. And now they're back.
They are back as a manufacturing customer. It's a key distinction. Apple still designs the chip. Intel just builds it for them. But you're right, the symbolism is enormous. Apple is the most demanding hardware company on the planet. They do not tolerate imperfections. They measure their tolerances in atoms.
Right.
For them to sign off on 18A proves that the foundry yields, which are reportedly over 60% now, are commercially viable for the toughest customer in the world.
So Apple isn't doing this out of the goodness of their heart.
Apple doesn't do anything for charity. They are doing it because TSMC is charging them a fortune, and they want price leverage. By bringing Intel online as a second source, they can go to TSMC and say, hey, match this price or we move more volume. It's a brilliant strategic move by Apple. It's a massive, massive validation for Intel's foundry.
So they have Microsoft, they have Amazon, and now they have Apple. That sounds like a royal flush. But there's another layer to this whole frenemy situation. We have to talk about NVIDIA.
This is one of the stranger and more interesting developments from late 2025. NVIDIA completed a $5 billion investment in Intel common stock.
Hold on a second. NVIDIA is Intel's biggest rival in the AI space. Intel is desperately trying to catch NVIDIA with their Gaudi accelerators. Why on earth would NVIDIA give them $5 billion? Is Jensen Huang just feeling generous all of a sudden?
Far from it. This is pure cold game theory. NVIDIA has a massive problem. They can sell every single H100 or Blackwell chip they can possibly design, but they can't make enough of them.
I thought TSMC was making all their chips.
TSMC makes the silicon die, yes. But the bottleneck for these giant AI chips isn't the silicon itself, it's the packaging. It's a technology called CoWoS chip-on-wafer-on-substrate. It's how you put the high bandwidth memory right next to the GPU. It requires incredibly advanced packaging capacity, and TSMC is completely tapped out. They're fully booked for the next 2 years.
So NVIDIA is just desperate for more capacity anywhere they can find it.
Desperate. And Intel has been investing billions in advanced packaging facilities in New Mexico and Malaysia. NVIDIA invested that $5 billion to effectively buy their way to the front of the line for Intel's packaging factories.
So they aren't investing in Intel, the company. They are prepaying for a VIP pass to the factory.
Exactly. It's supply chain hedging. And there is an element of co-opetition here. They are reportedly collaborating on some custom by 86 CPUs that will integrate NVIDIA RTX graphics. It's a pragmatic move. NVIDIA needs more factories. Intel has factories, but desperately needs cash to fund them. It's a marriage of convenience.
And it wasn't just NVIDIA, right? SoftBank also showed up with a big check.
Right. SoftBank Group put in $2 billion, and then the AI startup Samsung Systems committed $100 million just for compute resources. The theme here, if you look at the big picture, is that the entire industry needs Intel to succeed. There isn't enough global capacity to build all the AI chips the world wants right now. If Intel's foundry fails, the entire AI revolution hits a brick wall.
Okay, so let's just pause and recap for a second. They have what is arguably the best technology in a decade with 18A. They have the biggest customers in the world, Microsoft, Amazon, Apple signed up. They even have their chief competitor, NVIDIA, giving them billions of dollars. By all logic, the stock should be at an all-time high.
And yet
We look at the chart from late January 2026. The stock crashed 17% in a single session. It was a complete bloodbath. What happened? How do you reconcile all of this good news with that horrific financial reality?
this brings us to the really painful part of the story, section 4 of our deep dive, the supply air pocket. This is where the friction between physics and finance gets very, very ugly.
Air pocket sounds like a little bit of turbulence. This looked more like a complete nosedive.
It was severe turbulence, you're right. So despite all the technical wins, the Q4 2025 earnings report was complicated. Revenue came in at $13.7 billion, which was down 4% year over year. The full year 2025 was basically flat. But the real killer was the guidance for Q1 2026. They guided for revenue between $11.7 and $12.7 billion. That was a massive miss against what Wall Street was expecting.
So guiding down right at the moment they should be ramping up. Is demand falling off a cliff?
No. And that's the beautiful, painful irony of it all. They aren't guiding down because no one wants their stuff. They are guiding down because they literally cannot build it fast enough. Intel effectively sold out of its entire server CPU inventory in late 2025.
Wait. They ran out of chips. How does a multi-billion-dollar chip company run out of chips?
They ran out of the components to make the final chips. They hit acute supply constraints, specifically for two things: specialized substrates and high bandwidth memory, or HBM.
Okay, walk us through that. What is a substrate and why is it suddenly missing?
Think of the substrate as the circuit board for the chip itself. It's that little green square that connects the microscopic silicon die to the macroscopic motherboard of the computer. It uses a specialized material called ABF Ajinomoto buildup film. It's incredibly complex to make. The few suppliers for this stuff are mostly in Japan and Austria, and they just haven't ramped up their factories fast enough to meet the explosion in AI demand.
So Intel has the engine, the silicon, but they don't have the chassis to put it in.
Exactly. And you need the latest HBM high bandwidth memory to build the high-end Xeon server chips. The memory makers can't produce enough of that either. So if you're a cloud provider and you order a top-of-the-line Xeon processor from Intel right now, you might be waiting 6 months to get it.
That is just wild. So they have customers waving money at them, and Intel has to basically say, sorry, we're out of the ingredients to make your order.
Exactly. It's what you call a good problem, in the sense that demand is sky high. It's not a demand cliff. People desperately want the product. But it has a bad consequence for the stock price because you can't recognize revenue if you can't ship the box. That's why the stock tanked. The market hates uncertainty, and these supply chain constraints create a ton of uncertainty about the next few quarters.
And the financial health check beyond just the revenue number isn't exactly pretty either, is it?
No. To preserve every penny of cash for building these massive new factories, they suspended the dividend. For traditional Intel investors who held the stock for that income, the pension funds, the retirees, that was the final straw.
Yeah, they're gone.
They just dumped the stock and moved on. On top of that, they also completed a 15% workforce reduction in 2025.
Ouch. That is a lot of jobs.
It's a much leaner structure now. They're targeting operating expenses of around $16 billion for 2026. They are cutting to the bone in the existing business to fund the manufacturing expansion. The goal is to become cash flow positive by the end of 2026, but right now it is tight. They are walking a very thin financial tightrope.
It really feels like they're burning the furniture to keep the house warm while they're building a mansion next door.
That is a very apt analogy. And because the house was getting a little too cold for comfort, they needed a safety net. And that brings us to, I think, the most controversial part of the current Intel story.
The Uncle Sam factor.
The government stake. In August of 2025, the U.S. federal government acquired a 9.9% equity stake in Intel.
Almost 10%. That's huge. How did that even happen? Was this a bailout?
It was a deal born of mutual necessity. Intel needed capital to finish the massive fabs in Ohio and Arizona, and the government needed to ensure the goals of the THPS Act were actually met. So in exchange for about $8.9 billion in funding and some relief from some of the more onerous THPS Act requirements, the government took an equity stake.
Okay, I have to push back on this. People are calling this a safety net, but doesn't that effectively make Intel a government-controlled utility? If I'm a shareholder, do I really want a bureaucrat from the Department of Defense sitting in on board meetings telling Intel they can't sell certain chips to China? That sounds like a cap on your growth, not a safety net.
You are absolutely right to be skeptical. It is a massive double-edged sword. On one hand, it does create a floor for the stock price. The U.S. government cannot allow Intel to go bankrupt. It is now what you'd call quasi-sovereign. It is officially too important to fail for national security. The Pentagon needs advanced chips, and they need them made in America. Intel is the only game in town.
So bankruptcy risk is completely off the table.
Yes. But, to your point, it is also a ceiling on their operational freedom. It creates huge risks. It absolutely limits their ability to operate in China, which is still a massive market for them. It brings increased oversight and regulation. You effectively have a silent partner whose primary concern is national security, not shareholder value. And those two goals are very often in conflict.
Speaking of conflict and leadership, Pat Gelsinger, the architect of this whole 5 nodes in 4 years plan, he departed in late 2024. Who is steering the ship through all this now? Because managing the government has to be a full-time job in itself.
The new CEO is Lip-Bu-Tan. He took over after a brief interim period, and he's a very, very different animal than Gelsinger.
How so?
Gelsinger was the visionary, a real spiritual leader for the company. He was very high energy, very focused on the dream of restoring Intel's greatness. Lip-Bu-Tan is an engineering-first guy, but he is also a ruthless operator. He's known for being brutally honest. He's the one who looked at the bloated middle management that had built up over decades and just said, this has to go.
He's the surgeon.
He's the surgeon. He's the operator who has to make the math work now. He recently attended a high-level AI summit in India with leaders from OpenAI and Google, and the whole focus was on infrastructure. He wasn't there to sell a dream. He was there to sell factory capacity. The consensus on Wall Street is that 2026 is his show-me year. Gelsinger built the roadmap. Tan has to monetize it.
He has to turn this manufacturing turnaround into actual dollars on the income statement. So looking ahead, what does the rest of 2026 look like? We're in this air pocket right now, but what's on the horizon that could pull them out of it?
There are 2 big technical milestones to watch for. First is a product called Clearwater Forest. This is the next generation Xeon server product. It's booting in data centers now. This is crucial because Intel has been just bleeding market share to AMD in the data center for years. Clearwater Forest, built on 18A, is supposed to be the weapon that finally stops the bleeding.
And beyond 18A, what's next?
The next node is already in the works. It's 14A. Risk production has already begun on it. And this is the first node that's going to use High-NA EUV, those massive new machines from ASML that cost $350 million each.
Wait, explain High-NA EUV quickly. Why does a single machine cost $350 million?
So EUV stands for Extreme Ultraviolet Lithography. It uses incredibly powerful lasers to vaporize tiny droplets of tin to create a light wavelength that is so small it doesn't exist naturally on Earth. It's what allows you to etch lines on a chip the width of a human DNA strand. Wow. High-NA means high numerical aperture. It's basically a much bigger, more precise lens that allows for even sharper resolution. Intel bought all the first machines ASML could produce. They are betting the entire company on this technology for the next decade.
So they are not slowing down at all.
They can't afford to.
Yeah.
But for the investor listening to this, the narrative for 2026 is just messy. The analysts are deeply, deeply divided.
I've seen that. Some have price targets up at $65. Others are stuck on neutral or even sell.
The bulls look at the Apple and the NVIDIA deals and they say, the turnaround is real. This is the bottom. This is the time to buy. They see the supply constraints as temporary. The bears look at the supply air pocket, the massive cash burn, and the enormous capital required to run a foundry, and they say, this is dead money for the next 2 years.
It really feels like the comeback phase is technically over. They built the thing they said they would build. Now they are in the expansion phase.
And the expansion phase is notoriously messy. It's where you have to scale production, manage the yields, and fight for every penny of margin. It's not glamorous work, but it's where the profit is actually made or lost.
So what does this all mean for the person listening right now? We've covered the tech, the money, the customers, the government.
It means Intel is a unique beast in the market right now. It is the only U.S.-based leading-edge semiconductor manufacturer. It has, for a moment, the best technology in the world with 18A. But it is completely hamstrung by these short-term supply issues and this massive, painful transformation of its entire business model.
It's definitely not the boring dividend stock your grandpa owned back in the 90s.
Far, far from it. It's a high-stakes, government-backed, technology-led turnaround play in what is arguably the most important industry on Earth right now.
And that leads us to a final thought for people to chew on. We mentioned the government stake. We mentioned NVIDIA's stake. We mentioned the strategic importance of what they do.
Right. So if we just step back from the quarterly numbers, with the U.S. government owning nearly 10% and a key rival like NVIDIA owning a massive chunk, and with the business model shifting to being a foundry for other big tech companies, you have to ask a fundamental question. Is Intel truly a public company in the traditional sense anymore? Or has it effectively become a public utility for the AI era?
A utility?
Think about it. A power plant exists to enable other companies to run their businesses. Intel, in this new model, exists to enable NVIDIA, Microsoft, and Amazon to run their AI businesses. If they are the power plant for AI, maybe the growth profile looks very different than if they're just a chip seller. Utilities are essential. They are protected by the government, but they don't always trade like high-growth tech stocks.
That is a fascinating way to frame it. If they are now critical infrastructure, maybe the entire valuation model needs to change. Something to definitely think about as we watch those earnings reports roll in this year. We hope you enjoyed this deep dive, and thanks for listening. Please follow us and subscribe on your favorite platforms. Until next time. This analysis is based on publicly available information and does not constitute financial advice. Always conduct your own research before making investment decisions. By listening to this podcast, you agree that you are in charge of your own decisions and risks, and that you are solely responsible for any investment decisions you make.